Welcome to the deep dive. Today, we're taking a really close look at Rocket Company's third quarter 2025 results.
Yeah, and it's more than just the numbers, right? It's about their big strategy.
Exactly. This whole idea of becoming a uh, vertically integrated home ownership company, sort of in a category of one, as they put it.
That phrase really says it all. They're not just tweaking the mortgage business, they're trying to rebuild the whole thing. Lending, servicing, finding the customer all under one roof.
Right. But to really get what they did in Q3, we need to set the scene. What was the market like?
Well, Q3 2025, it was still pretty tough. Grinding, maybe.
That sounds about right, though there were some glimmers of hope.
Yeah, a little bit. The 30-year fixed rate, it did ease off a bit, down about 40 basis points, landed around 6.3%.
Okay, that helps affordability slightly and home prices.
They slowed down too. Price growth moderated down to about 3.1% year over year. That's a fair bit lower than the 5.5% we saw back in January.
So, small steps in the right direction. But the big problem remained inventory.
Absolutely. That's the real bottleneck. Existing home sales were just stuck, you know, hovering around 4 million units annualized.
Which means 2025 is looking like the slowest year for sales since
That one.
1995. It's a major headwind. People, buyers and sellers, they're kind of frozen, waiting for clearer signs on rates.
Okay, so that context, that tough waiting market, makes Rocket's Q3 performance even more interesting.
Definitely. Because they didn't just survive it.
No, they seem to thrive while juggling these massive strategic projects. They beat their own guidance.
Right. Exceeded the high end of adjusted revenue guidance.
And they closed and started integrating the Mr. Cooper acquisition.
Which, following on the heels of the Redfin deal, is just enormous. Largest independent mortgage company transaction ever.
So a really defining quarter. Let's talk financials, but maybe focus on what really signals success in this kind of market.
Yeah, absolutely. Market share gains become the real story when the overall pie is shrinking.
Okay, so what were the key numbers? All right, first, that headline. Adjusted revenue hit $1,783 million. Beat their guidance.
Okay. And what drove that? Volume.
Volume was strong, showing intent. Net rate lock volume, that's people locking in rates, a forward look was $36 billion. That's up 26% from the previous quarter.
$36 billion locked in closed loans.
Closed loans came in at $32 billion, which is up 11% quarter over quarter.
And the market share piece.
Crucial point. They said Q3 was their strongest quarter for gaining share in both purchase and refinance markets in the last 3 years. So they're definitely taking business from others.
And profitability, that jumped quite a bit too, right?
It really did. Adjusted EBITDA hit $349 million, and the margin expanded significantly from 13% in Q2 up to 20% in Q3.
Wow. So how did they manage that jump, especially while integrating a huge company like Mr. Cooper? Was there a specific catalyst?
There was. The source materials point to a brief but intense surge in refinance activity right there in September.
Ah, okay. What happened?
The 30-year fixed rate just dipped slightly, about 20 basis points, down to that 6.3% level.
And Rocket was just ready.
Exactly. Their platform apparently just kicked into high gear immediately. They captured that little window of opportunity. It really shows their responsiveness and, frankly, their capacity.
That speed is key. Okay, let's broaden out now to the bigger strategic picture. This category of one idea. It's about breaking down silos, isn't it?
Totally. Traditionally, you find a house, find a realtor, find a lender, get passed to a servicer. It's all separate steps, separate companies often.
And Rocket wants to stitch it all together.
Yeah, create one seamless flow. That's the goal. Let's start at the beginning of that journey with Redfin.
Right, the top of the funnel, getting the customer early.
Redfin provides that. A stream of low-cost leads from people who are actively, looking for homes, high intent.
And the integration there is moving fast.
Seems like it.
Wow.
Faster than they planned, apparently. The number of people starting a mortgage application on Redfin actually doubled just between July and September.
Doubled. To what level?
Over 500,000 users started an application in that period. But the really telling number is the attach rate.
That's the percent of Redfin buyers who use Rocket for their mortgage.
Exactly. And that climbed really fast, from 27% up to nearly 40% in just 4 months.
Wow, okay. That's significant pickup.
It really is. It shows the synergy is working. And it means, for you listening, that Redfin source deals made up 13% of Rocket's retail purchase loans in September alone.
So a built-in, efficient lead source. Now let's flip to the other big piece, Mr. Cooper, the recapture engine.
Right. This adds the industry's biggest servicing portfolio.
And servicing is Well, it's complicated, but crucial, especially in the current environment.
It is. Let's maybe unpack that a bit.
Hmm.
The combined portfolio is now close to 10 million clients. That's huge.
10 million, and that generates stable cash flow.
About $5 billion a year in stable, recurring cash flow from servicing fees. And we should probably explain MSRs quickly.
Yeah, please do. Mortgage servicing rights.
Right. It's the right to collect the payments, handle escrow, customer service, etc. for a fee. Now, here's the key part. When interest rates go up, like they have been.
People don't refinance as much.
Exactly. So they're less likely to leave the servicer. That makes the MSR asset itself more valuable.
Ah, so while higher rates hurt the origination side of the business.
They actually boost the value of the servicing side. It acts like a natural hedge, stabilizing earnings.
Got it. So the Mr. Cooper deal isn't just about adding customers, it's a massive strategic hedge.
Precisely. And the speed of that integration was pretty remarkable, too, according to the documents.
What did they say?
Get this. By day 9, after closing the deal, they already had 40,000 leads flowing from the Mr. Cooper servicing book into the Rocket sales pipeline.
Day 9, 40,000 leads.
Yeah. By day 12, the first Mr. Cooper client closed a refinance loan with Rocket. Took just 3 days start to finish.
Closing a loan in 3 days right after merging systems like that speaks volumes about their tech and process.
It really does. And it explains why their overall recapture rate, getting existing servicing clients to do their next loan with them, is apparently 3 times the industry average. They can act on those internal leads instantly.
Okay, so stepping back, the integrated structure, Redfin feeding leads, Rocket originating efficiently, Cooper Rocket servicing and recapturing.
It's designed to work in basically any rate environment. Rates go up. MSRs and servicing cash flow provide stability. Rates go down. That massive 10 million client book becomes a goldmine of low-cost refinance and even purchase leads.
A two-sided machine, as you said, resilient.
Very resilient.
But none of this speed, none of this integration would really work without the engine underneath it all. Which brings us to AI.
Yeah, AI is clearly the multiplier here. They talk about it touching everything, growing the funnel, improving conversion, cutting costs, boosting recapture.
They used a term, agentic AI. What does that mean in practice?
It means they're building AI tools agents that don't just answer simple questions, but can perform complex tasks, make decisions, almost work autonomously.
Okay, like what? Give us some concrete examples.
Right. One they highlighted was the pipeline manager agent for loan officers.
What does that do?
It basically ranks all the potential leads for a loan officer using predictive analytics. Then it even drafts customized text messages based on past interactions with that client.
So it tells the loan officer who to call next and even suggests what to say.
Pretty much. And during that September refi surge we talked about, this tool apparently drove a 9-point jump in follow-ups actually happening.
9 points is a lot.
And a 10% lift in the conversion rate for those loan officers. It focuses their human effort where it counts most, especially when things get busy.
Okay, that's direct impact on sales. What about the back end, the paperwork?
Huge impact there, too. The purchase agreement review agent. Apparently reviewing one purchase agreement used to involve over 80 manual steps. Tedious stuff.
80 steps. Wow.
This AI agent cuts the processing time for that review by 80%. 80%.
That's incredible. What does that translate to in terms of save time?
They estimated it saves over 150,000 team member hours annually, just from that one agent.
Yeah.
Think about freeing up that much human capacity.
Yeah, that's not just cost savings. That's letting people focus on more valuable work. It changes the job.
Absolutely. And the overall result, their production team members, the people actually processing loans, can now handle 63% more loans than they would just 2 years ago.
63% more productive, largely thanks to AI.
That's the story they're telling. And they're building these agents fast, too, sometimes in less than 3 weeks.
So if AI is doing this for origination, the next frontier has to be that giant servicing portfolio, right?
For sure. They explicitly mentioned AI's role in the future of servicing, handling payments, questions about forbearance, property taxes, all ripe for AI agents.
The goal being.
They talk about agentic AI that anticipates client needs, 247, building towards what they call infinite capacity across the whole company.
Okay, let's look ahead then. Q4 guidance. What are they expecting?
They guided for adjusted revenue between $2.0 billion and $2.3 billion for the fourth quarter.
And that's the first quarter with both Redfin and Mr. Cooper fully baked into the numbers.
Correct. Fully consolidated. And that guidance is strong, even considering the usual holiday slowdown, fewer workdays. People are distracted. They still expect to gain market share.
Driven by that integrated model feeding itself.
Exactly.
And looking further out, say into 2026?
The tone was definitely optimistic. They pointed to forecasts like Fannie Mae's, predicting maybe 25% market growth year over year in 26.
And the potential for rates to dip below 6%.
Right. If those conditions happen, they feel this combined AI-powered entity is set up to, quote, force multiply results. They're less dependent on just the market lifting all boats.
They feel they can outperform significantly because of the structure they've built.
That's the core argument.
Okay, so let's boil this down. What's the main takeaway for you, the listener?
I think the key insight is how this new integrated model is designed to handle the ups and downs of the interest rate cycle. It's structurally different.
How so?
When rates are high, the MSRs and the steady cash flow from that huge servicing book provide a buffer. They stabilize earnings when rates eventually fall.
That same servicing book becomes this massive, low-cost source of refinance and purchase leads.
Exactly. They can capture that upside with high margins because the customer acquisition cost is so low, they already have the relationship. It's built to benefit either way.
It makes them less vulnerable to just waiting for rates to move. They've built internal engines for growth and stability.
Right. It shifts the focus from just riding the market wave to optimizing their own internal ecosystem, lead gen, conversion, retention. It's a model that's hard for fragmented players to copy.
That structural resilience really is the big story here. So let's wrap up with a final thought for you to consider, something that builds on what we've discussed.
Yep.
We talked about that massive combined servicing portfolio, and the source material mentioned a specific data point. If the 30-year fixed rate does fall to, say, 5.5%,
Which is within the realm of possibility in their modeling.
then something like $300 billion in unpaid principal balance within their current portfolio would suddenly be in the money to refinance.
A huge chunk of your client base.
Exactly. So the provocative thought is, what kind of inflection point could that 5.5% number represent? Not just for refinancing, but maybe unlocking broader home buying demand too. And critically, how fast could this newly integrated AI-fueled rocket machine capitalize on that massive wave of potential activity the moment that psychological barrier is breached? Think about the leverage they've built aiming right at that specific possibility.